Good afternoon, and welcome to the Personal Group Holdings PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to CEO Deborah Frost. Good afternoon to you.
Hello everybody and good afternoon. Thank you for coming to our preliminary holdings and preliminary results and strategy update. As we normally do, I'm going to take you through a very brief overview of the year, and then I'm going to hand over to Sarah Mace, our Chief Financial Officer, who will take you through the numbers in more detail before handing back to me, and I'll go through some of the more operational and strategic focus of the business. And we're obviously, as Alex has just mentioned, we're ready for questions at the end. So anything that you'd like to ask, please go ahead. Right, so I'm just going to kick off a little bit of an introduction to the business. I appreciate we have a number of investors who are very familiar with the company, but for those who are new or perhaps need a refresh, just to remind you, we're an employee benefits company. We work with all sorts of companies across the UK marketplace, from very large enterprise companies through to the smallest small medium enterprises through our partnership with Sage. We have a platform which contains benefits that companies, particularly larger companies, can bespoke as they wish. Some of those benefits we own ourselves, particularly our employee paid insurances. Those cover death benefit, and we also cover people if they are unfortunate enough to go into hospital, and we sell those primarily to organisations who aren't able to offer things that other companies might take for granted, like death in service or sick pay. We also own a benefit, a technology salary sacrifice benefit, which allows employees to buy technology through their business. They are able to get savings on national insurance contributions, and it's also quite a saving against buying it against the high street, because you're not asked to pay for any credit terms, which obviously these days are much more expensive than they were before. You know, Currys credit card is now running at something like 25% interest rate, so quite substantial. And again, the people that would buy technology through salary sacrifice, it might be mobile phones, laptops, that type of thing, they're often not in a position to just buy something outright. They tend to need to buy it over a period of time. We also have a reward consultancy division, which we added to through the year, and I'll talk a little bit about that. Sorry, I'm getting my words muddled up. I'll talk a bit more about that later on. But our reward consultancy division helps businesses thinking about how much they should be paying people, whether there should be a bonus in place, and things like gender pay that are required by statute. So we have quite a range of offering across the business, and you can see in that donut that where previously the business was primarily focused on making EBITDA through our insurance products, over the last few years we've really developed EBITDA streams in other sectors. And I'm just going to show you the range and breadth of clients that we work with. So we have a lot of clients in our enterprise, our sort of core areas, so people like DHL, Wincanton, traditional clients of the group. But over the last few years, we've added significant other clients for reward consultancy, the platform itself, and Let's Connect, our technology salary sacrifice business. So a whole range of organisations work with us, and about 30% roughly take more than one line of business. We have a partnership with Sage. We're 1 year into a 5-year agreement with Sage to provide a Sage employee benefits platform for them, and we sell that to small and medium enterprises. And again, I'll talk a bit more about that as the presentation progresses. In terms of my view of the highlights of the year, we exceeded expectations, I suppose, in terms of where we were at the half year. I know there was some doubt from some investors around whether we might hit the numbers that we set ourselves, and we did deliver those numbers. So we met expectations in total for the year, and that was underpinned, and I'm particularly pleased about how well we did with insurance sales. So annualised insurance premium sales through the year of 9.5 million, which is up. In fact, it's the best year that we've had since 2018. So quite significant growth in the insurance business. We added 101 new clients across the whole group in comparison with 86 last year. So, pleased with that. and continued growth with the partnership with Sage, adding 1,200 small and medium companies over the 12-month period, and all of those have continued into the start of 2023. So we're continuing to see that momentum that we built in the second half really develop. I'm not going to go through these numbers in a lot of detail, but I think what they do show is that we have the right offering. You know, you'll be aware of how tight the employment market is. Unemployment is at historically low levels, and wage inflation has been very expensive for businesses. So they're looking for something to enhance their value propositions for employees, which doesn't just require more money on wages. And that's where a voluntary benefits platform such as we offer can come in very helpfully. We offer discounts. We offer, as we've talked about, some of the benefits we offer. We offer third-party benefits as well, employee counselling, online GPs, all sorts of things really. And that leads us to believe that there's a very large growth opportunity for us over the coming years. We're in a strong financial position as a business. We have 8.7 million cash in the bank. We also have an equity investment, which brings in total our reserves to about £20 million. We have no debt and we pay a dividend. And we own our own software. And as you can see, that bottom number there, 5.6 million annual recurring revenue across all our platforms, significant increase on the 2021 number of 3.6 million. So it feels like we're going in the right direction, and certainly we're seeing underlying double-digit growth across all areas apart from Let's Connect. I'm going to hand you over to Sarah now, and she can take you through the numbers in a bit more detail. So over to you, Sarah.
Great, thank you, Deborah. So I'm going to start off with the overall sort of summary results. Deborah's already mentioned we delivered a strong second half performance, which meant that our EBITDA was in line with market expectations for the full year, so 4.5 million in the second half versus 1.5 in the first. We saw group revenue rise to just under 87 million. A substantial element of that was from what's called voucher resale. And for any of you that have been on our presentations before, you'll know this is essentially pass-through revenue through people spending and getting discounted shopping vouchers and the like through our benefits platform. It does only have a minimal impact on EBITDA, but it is still massively important to us because it reinforces the value of our benefits platform, both to our clients, so the employers using the platform, and also the end employees who are able to benefit from using the discounts. And we really saw a sort of upsurge in that in terms of the cost of living crisis and people taking more advantage of those discounted offers. But outside of that, we saw growth in revenue across all areas of the business other than Let's Connect. And we ended the year with EBITDA broadly in line with 2021 at 6.0 million. In terms of, we'll come on to each of the individual areas in a second, but in terms of the key contributors to that result, we were expecting a reduced contribution from our insurance business, which I'll come on to explain in a bit more detail later. But essentially, we were at the sort of low point in terms of the size of the insurance book and the high level of acquisition costs that we were investing in the business to be able to put our field sales team back out on the road. And that was offset by contributions from other areas of the business. I'm going to talk about the impairment of Let's Connect goodwill on a separate slide, if that's okay. And you'll see on the right-hand table, we've stated the sort of PBT and EPS numbers, both including and excluding that impairment amount, simply because it is it's a non-cash item. It's not impacting our underlying profitability. In terms of dividend, we've announced a final dividend of 5.3 pence alongside these results, taking us to a total of 10.6p for the full year, which has been maintained in line with 2021. This has meant a high payout ratio for the year, essentially around 100% of post-tax profits, excluding the impact of the Let's Connect goodwill impairment. And that's because we're very cognizant that a lot of our investors hold us as an income stock. And also as a board, we've considered it in the context of the underlying growth that we've seen in the business during the year, and also our continued confidence in our forecast for 2023. And as Deborah's already mentioned, we are a very strong financial position, cash generative, cash and deposits of 18.7 million, alongside a 1.3 million equity investment, no debt, and that obviously keeps us well positioned for future growth. So just before I move on to the more detailed results, I've just got a slide here again for any of you who haven't been to one of our presentations before. We report our results under the 4 core segments that Deborah spoke about at the beginning, so pay and reward, benefits platform, insurance and other own benefits. And on the right-hand side of that table, you can see the different income streams that come in from each of those areas. So for pay and reward, predominantly consultancy income, also some survey income, but also some SaaS income in terms of the digital platforms that they have for job evaluation and pay benchmarking. The benefits platform, majority of that is digital platform subscriptions again, but we do also get some commissions from some of the third-party benefits which sit on the platform. Insurance, obviously premium income, and then other own benefits, which is the salary sacrifice benefit that Deborah spoke about. For us, it's essentially a retail sale. So we make the sale of the equipment to the employer, who then separately goes ahead and does a salary sacrifice agreement with their own employees. So just looking at the results in a little bit more detail, you can just see the breakdown there of the various contributions from each of the areas of the business. I'll probably focus on the sort of red box there in terms of demonstrating the underlying growth that we've seen during the year. So in terms of insurance, we saw our API, so annualised premium income, the size of the insurance book increase from just under 24.5 million to 28 million. And in terms of SaaS subscriptions across benefits, platform and pay and reward, up from 3.6 million last year to just over 5.5 in 2020 at the end of 2022. And what that does is it obviously gives us increased visibility in terms of our future revenue streams as we move into 2023, and obviously fairly clearly demonstrates that our underlying growth has continued as we've moved through 2022. Then I'm just going to talk a little bit about each of the areas. So pay and reward, we have two companies under pay and reward, so Enecto and QCG. QCG we acquired on the 1st of July this year. So obviously the first half results are Enecto only, the second half include QCG. Enecto itself saw strong organic growth, so you can see their consultancy income up over a third, and the SaaS income from their digital products up just under 20%. And they've got annualised recurring revenue of around 550,000 at the end of December 2022. And then you can also see there the contribution from QCG in the second half of the year, which was in line with the acquisition targets that we set on acquisition. So moving on to benefits platform. So this is where the expansion into the SME market is really coming into play and being the biggest driver of growth here. Collectively across both platforms, so the Happy Enterprise platform and the SME platform via Sage, we saw external revenue up 46% year on year. But we continue to see a substantial increase in the contribution from the SME element via Sage Employee Benefits. ARR up to 3 million at the end of December versus 1.6 a year before, and the Happy platform up to 2 million versus 1.5 at the end of December 2021. Moving on to insurance. So in 2022, we really saw the rebuilding of the insurance book sort of continue with full flow. Obviously, at the half year, actually, if anybody attended one of our presentations, we were actually behind in terms of premium income year on year, but the growth of the book has accelerated that through to growth overall for the year by the end of December. New insurance sales, Deborah spoke about at the beginning, really strong in terms of new business, 9.5 million, with the majority from face-to-face activity. 2021, 3.7 million, and for context, in 2019, which was the last year sort of pre-pandemic, when we had the field sales team out selling insurance, was around 9 million. And there's a graph at the bottom left-hand corner of this slide where you can see since the second half of 2021, where we've been back out in the field, able to sell our insurance products and sort of building back up that sales team, you can see how that new business sales has started to accelerate. Alongside that, for existing policyholders, we've continued to see strong retention rates. So that's both first year retention and year-on-year retention rates. We saw those increase during the pandemic, probably not surprisingly given the nature of our products, but those rates seem to have continued as we've moved into the second half of 2021 and 2022. So our year-on-year retention remains above 80%, 81% at the end of the year. And a combination of those new insurance sales and good retention rates is what's driven the book up to the 28 million that we can see at the end of December. And for those of you that don't know, our policies are not annual policies that renew every year. They are in the main weekly or monthly contracts that just roll. And we collect the majority of the premiums through payroll deduction as well, which sort of keeps that recurring revenue coming through. Little bit about claims. So the loss ratio, historically, our loss ratio has been very steady around the sort of 25% mark. During COVID, we saw that drop off slightly, particularly around the hospital plan, simply because the NHS was focusing on COVID and not doing the kind of outpatient appointment levels that we've seen historically. We're expecting that to increase as we came into 2022 and the NHS started to address their waiting lists. But equally on the death benefit side, we have started to see the loss ratio there start to move back down again, not to the levels that we saw pre-pandemic, but certainly back down towards them. And then in terms of overall profit contribution, there's a sort of bridge under the table there that hopefully helps to sort of explain why we had that reduced contribution. We're expecting to see that reduced contribution in 2022. So we saw an increase in our premiums, which obviously increased the contribution there. We saw a slightly bigger offset in terms of claims because the loss ratio across the whole book was increasing as we expected it to. But really the biggest chunk, I guess, in terms of reduced contribution was where we were building the field sales team back up to full strength. So you can see there the acquisition costs for the year were 5.1 million in comparison to 3.5 million in 2021. And the nature of our policies, the sort of weekly and monthly rolling nature of them, means we have to take all of those acquisition costs up front, but we'll obviously see the benefit of that premium income over the next, well, an average policy life is around 5 years. And then finally moving on to Let's Connect. So Let's Connect's major client is Royal Mail Group, and obviously that business was impacted by industrial action at the end of the year, and in particular what's normally Let's Connect's peak period. That did mean that revenue was down on the previous year, clearly impacted by that sort of reduced activity that we were unable to do. At Royal Mail's request, we would normally do marketing to their employees that we weren't able to do as normal. But we did make some of that sort of shortfall back up in terms of margin, where we managed to increase to 13.7%. Combination of product mix and pricing meant that the EBITDA contribution was broadly maintained. It's still a very popular benefit. Order numbers are up slightly on 2021 despite that lower revenue, but the average order value that we saw people putting in was below historic levels. Combination of restricted availability still around some of the high value products, so large TVs and the like, but also potentially people's sort of spending power in terms of how much they wanted to commit to sort of paying each month. And then just in terms of the impairment, so we acquired Let's Connect in 2014. The last few years, we've obviously had sort of supply chain issues through COVID, which haven't completely gone away as we've moved into 2023, although significantly better than they were. However, with the ongoing issues at Royal Mail, and they've basically, they're no longer able to run a salary sacrifice scheme with their employees in the short term. We've taken the prudent decision to fully impair the goodwill that arose on that acquisition. And then just before I hand back to Deborah, I guess the key messages from my point of view is, we're definitely able to see that underlying growth coming through across the business. So whether it's premium income, size of the insurance book or SaaS revenues, clearly seeing good growth there, which provides good visibility of future revenue streams. We've now passed the low point in terms of EBITDA contribution from the insurance book. And as we roll into 2023, we should start to see the increased underwriting profit starting to come through. And as we sort of, Deborah spoke about at the beginning, we remain in a really strong financial position and well positioned for growth. So I'll hand back to Deborah to go through the strategy update.
Thank you very much, Sarah. So just a view from me in terms of how we've been doing in our progress, particularly against the strategy that we set ourselves at the start of last year. So just to really remind you of why we believe there is a significant growth opportunity in the UK market. You'll be aware that obviously employment is very tight and there are real issues for employers around how they engage with staff, how they promote well-being. Some of the things that started to creep in COVID have become much more established. So, for example, things like being able to see a GP online is much more common practice now in benefit platforms. And we're able to offer a full range of those facilities. And we can, for our larger clients, we bespoke it to their individual needs. We also have a native mobile app, which has always been important to us because a lot of our clients traditionally don't have people that work behind desks. So we work in food manufacture or care or lorry drivers, all of whom need mobile access. But actually, in these days of hybrid working and also, frankly, most of us using our mobiles for everything, it's probably just as important for everybody to be able to access things through their mobile rather than just relying on a desktop site. So I think the combination of that plus the reward consultancy that we started at the beginning, talked about at the beginning, where employers can get help on pay benchmarking, they can get help with how to do a pay review, look at bonuses and things. It does make our offer unique in the mid-market. And I think some of the progression numbers I showed you earlier in terms of the number of client growth and so on really does support the view that we are in the right place, doing the right thing with clients. We've expanded our offer significantly over the last couple of years to work not just with large enterprise clients, but across the whole of the UK economy. So we have clients now in the public sector in what we call talent driven. So that would be those organisations that are probably less concerned about salaries in that, they need to attract and retain scarce talent. And the benefits platform can support them in doing that. And then obviously the significant growth that we've seen over the last 2 years in the SME sector of the economy. So just looking at that in a bit more detail, we set ourselves goals at the start of last year around unlocking EBITDA growth for the business as we came out of COVID. And we articulated that in a number of different ways, particularly around increasing the number of employees that we served. So last year, at the close of 2021, we served about 1.25 million employees in the UK. That's now at 1.4, so getting quite close to our goal of 1.5 million UK employees. And we've also seen quite significant progress across the 3 pillars that we identified as really crucial to growth. So those 3 pillars are about driving insurance, transforming our reward and benefits offer, and finally, how do we accelerate our offer, originally with Sage, but increasingly how are we going to accelerate that more widely. So I'll go through those in more detail and just give you some particular examples of how we're starting to see real tangible progress against those goals. So the first thing that we've talked about a bit is significant progress in driving insurance. So we managed to move the employment of number of field sales teams from 27 people to 47 over the year. And that is obviously a very significant investment, as Sarah said, in that sales team. Typically, in historical times, we've always had around the 45 sort of number. This year, we're aiming to keep that number between 45 and 50 field sales teams. We feel that we've got the clients who want us to go and sell insurance and talk to their employees about the benefits platform. We feel that we've got enough to justify that number of employees and keep them busy. And certainly, we had a number of very strong performances last year. So we had our best ever month in insurance sales in November. We had our best ever December in December, and we had our best ever performance by a single sales colleague through 2022. So really high performing year. And we've also focused very strongly on looking at all parts of the policyholder journey and improving retention at all stages. So our retention year on year, i.e. after you've done 12 months, has always been very strong. It used to be around high 70s, it's now low 80s. So that means in terms of percentages, we keep 4 out of 5 or slightly better than that policies year on year. But we've really focused on the retention in the first year, right from improving our early cancellation rates all the way through to keeping people after 6 months. So we've done a mixture of different things to really pull apart that journey and improve every stage of it. It's sort of a bit like British cycling, I suppose. There's probably a lot that we can gain through small incremental changes, which in themselves aren't massive, but overall make a real difference in performance. And those are some of the things that we're focusing on in 2023 to continue to look at some of those elements. But I just wanted to really emphasize that this isn't, it's easy sometimes with sales teams to just push them really hard and you get a real bit of delivery, but it's not sustainable. And I think what we've done, we've got a new lead in the insurance part of the business, and he has really focused on building bridges across the whole business. So right from account management. So the account management team actually reporting to Karen Thornley, who's our Chief Commercial Officer, and they're the ones that tend to deal with head office, HR directors, reward and benefit managers, but right through to our site visit team and the sales team themselves, and making sure they're working together for the benefit of our clients in the most effective way they can. And this was just a really nice quote that I got from the staff survey. It's an anonymous quote, but a quote that was in the staff survey that we did towards the end of last year, which I think is really valuable to understand how people are feeling about the business. So we're very pleased with insurance, and certainly we've started 2023 very strongly. We were a little bit worried at the end of 22. We'd written so much business towards the end of the year and really seeing momentum. Would we come back after Christmas to find that people were worried about cost of living and they were perhaps cancelling policies, but we haven't seen that. We've kept a real eagle eye on cancellations, and we haven't seen a spike. And in fact, we've continued to see sales through the first quarter of 23. So that momentum seems to be continuing, which is really good news. Let's talk a bit about the reward and benefits platform pillar. So we made a small acquisition in the second half of last year. It wasn't significant in terms of adding a lot of profit, but it does add a wider range of clients. QCG have a practice in the rail sector, in construction. They work with a lot of government organisations, and they also have quite a big footprint in the museums and leisure sectors, all different to the sectors that we work in with Inecto. So they're very complementary to the Inecto offer. We've seen some nice growth there as well. So we've seen platform sales, 22 new clients joining us with the platform, up annual recurring revenue. So at the end of the year, annualised recurring revenue then up 29%. Inecto digital growth, which is the digital platforms, also up. And we're continuing to cross-sell across the group in order to introduce different clients to different lines of business. We've got a big launch coming up with the redevelopment of the Happy platform. So we originally devised the Happy platform back in 2016, and obviously that's quite some time ago. And although we have been developing over time, it makes sense for us to take another look at it. Expectations have changed, probably from HR directors. They want to see more management information and elements like cybersecurity, and making sure that it's easy for third-party products to click into or plug and play into the platform is also really important. And we will be making some savings around the way that we're platforming the Sage and Happy platforms currently, and that will reduce development time. Caravan Club is a really nice organisation to give you as an example of how that's working. So they first started working with Inecto. The Caravan Club, and just to be clear, this isn't the Caravan Club members, it's the Caravan Club employees. They have a lot of sites around the country for campers and caravanners, and each site has a site manager, often a couple, who run that site. And they've been really pleased with the way that they've been able to implement the Happy app, and that has enabled them to communicate directly with people, and also to introduce a new recognition programme, which is going live later in the year. And a really nice quote here from Kerry, who's our client at the Caravan Club. The Happy app is like a magic toolbox that brings all the pieces together on a daily basis. So a real ringing endorsement there from a client who, as I said, has been a long-term Inecto client, and now it's great that they're working with other parts of the group. And then just turning finally to our growth in the Sage relationship, but also talk a little bit about our plans for SME clients more generally. So we started 2021 with about 30 clients on the platform that we share with Sage, 700 paid for employees. And at the end of 2022, we had annual recurring revenue of about 3 million and employees numbering over 50,000. So really a very significant growth over that couple of years, and the partnership is working really well. As I said a moment ago, it's a 5-year partnership with a year or already gone on the contract, so 4 years remaining, but very positive relationship with Sage, and a number of different ideas about how we might develop that relationship with Sage in 2023, but also to build new partnerships outside of the one with Sage, where we can work with other providers of services to the SME sector to build more relationships, more clients, and so on, and to build another platform which we would then sell, probably branded like we do with Sage Employee Benefits, for the use of different organisations. So there's a lot of work going on in that space, and I think it's entirely warranted by the growth we've seen. There's clearly a lot of demand there for the platform in the small and medium enterprise sector. Just an example here of actually a larger client. So although Sage in theory is under 250 employees, this is towards the top end of that, or even a little bit over. NRG Riverside are a larger client working with us with Sage. They are specialist fleet services, so they pick up broken lorries, they fix lorries. So they're very much recruiting lorry drivers and technicians, which is a very, very demanding area in terms of trying to find people and keep them. And Jenny, who's the HR director, set some goals around the platform use, what she wanted to see. And she's confident that actually introducing the platform has helped reduce their staff turnover by about 12%, which is really positive for them. And again, a lovely quote from her in terms of the way that they're using on-demand GP. Again, you can imagine if people aren't at home, they're out driving in a lorry, being able to see a doctor online is very helpful, and being able to offer counselling. As a small business, you probably don't have trained counsellors on site, but being able to provide professional services in that space is really useful. And obviously she's delighted with the way the partnership has transformed their business, and we're delighted for her too. So in terms of just turning for a moment to our ESG achievements and what we're doing in that space, you'll notice immediately that we've suddenly got 4 columns. So instead of ESG, we've got ESSG. And the reason why we've introduced that 4th column, society, is really around the fact that we do not only support our own employees and the community that we work in, particularly in Milton Keynes, but also we support clients to meet their needs for their employees and communities. So the low-cost employee paid insurances are meeting the needs of a group which is really underserved by financial services. They're very simple products. They're quite low value. So, you may have life cover which is significantly more than 10 or 20,000. But for our audience, that works really well. They're very simple products and people can pay for them through payroll. We also offer discounts. We offer mental health support, as I've mentioned, online GPs, all of which helps companies deliver their social goals. So we help them meet their own objectives for their own staff. And then finally, just the last slide, which, I always like to remind you really. So at the end of the presentation, and we're looking forward to, going on some questions, but what are the key takeaways? And I think the key takeaways for me this year are really strong insurance revenues, gained momentum towards the end of the year, which have continued into 23 and have given us a lot of confidence for the year to come. We expect the re-platforming and redevelopment of the platform that I mentioned to make a big difference in 2023. Initial clients will be going live in May, with a view that Sage will transfer across towards the end of June, and then our enterprise clients gradually moving over the summer and into the early autumn. And that will improve a number of facilities within the platform and also make it easier for us to work with third-party providers. So it feels to me there's a lot of evidence that we're seeing, myself and the board, that we really have got the right client offering. We're able to deliver things that clients are looking for. We've got very high retention of client numbers, and also on our insurance side, which makes me feel that we are definitely have the right offering for today's world, and it gives us confidence about long-term growth into the future. So that concludes the presentation, and now open for any questions that might come. There are a couple up there already, one of which I'm going to let Sarah answer.
That's great, Deborah and Sarah. Thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Deborah, Sarah, if I may just hand over to you and ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end. Thank you.
Okay, thank you very much. There's quite a few questions there, so we'll go through them, and if there's any that we don't get to, we can answer separately. So there was actually a question that came in, a couple of questions on the same topic that came in, and also our institutional investors asked us, which was about our Chief Operating Officer, Liam McGrath, who joined us, I think, in January. I can't remember when he joined us, in May, and left a year the following August. So he was with us for just over 12 months. Questions about what happened. And to be honest, Liam went to a different job. There wasn't any sort of push from us. We was doing a good job. We were happy with him, but he was offered something with a private equity backed business that he was really interested in, and he went. So yes, we were a bit disappointed, but he brought with him a guy called Steve Bush, who is now running insurance and is doing a fantastic job. So although Liam's gone, we've got someone very able in his place, and I appointed Steve to my senior leadership team at the end of the year. So we're very confident in what we're doing there. Sarah, there's a couple around corporation tax. Do you want to answer those?
Yeah, I'll do the next couple. So the first one, how will the increase in UK corporation tax to 25% impact profits, particularly EPS and dividends? So obviously, we are a business that's directly impacted by that change in corporation tax. So next year we'll pay that blended average of 23.5%. It does have a direct impact on our EPS and in turn dividend. But I think in terms of our dividend policy, that remains unchanged. And I think for those of you who held our shares when we changed our policy from a sort of quarterly and advanced dividend to a half year in arrears dividend, we did state at that time that we would aim to pay around 85% of our post-tax profits as dividend. So that policy remains unchanged, but it will be impacted by the higher corporation tax rates. And then the next one is, how is high inflation affecting hospital plan pricing? Are you automatically increasing premiums and benefits for rolling customers, or only new ones, and by how much? I think probably just to be clear on our policies, we're not like private medical policies. So our hospital plan pays out a fixed amount for a hospital trip. So the average level of cover people hold is around the £50 mark. So if they go to an outpatient appointment or they spend a night in hospital, they will get a fixed benefit of £50. So inflation, we're not affected by inflation in terms of the amount that we're paying out. We also only increase our premiums for new sales. So because of the price that somebody signs up to today is the price they'll pay for the whole life that they hold that policy, we don't go back and increase our prices for the back book, if you like. And I guess in terms of new customers, one of the key differentiators of our insurance products is we have the face-to-face sales team that's able to go and talk to what's basically a sort of underserved population in terms of insurance. So obviously we do sort of increase our prices in line with the wage inflation, if you like, that we're seeing in terms of the field sales team.
Okay, that's great. Thank you for that, Sarah. I've got, I think, a couple of questions which are slightly connected around Royal Mail. So just to be clear, there's a question here that says Royal Mail is up for renewal this year. Is there any indication they might not renew? So there's a couple of elements to our relationship with Royal Mail. One is that we support them. We don't have a benefits platform with them. They use a different provider for their benefits platform. We do have a major relationship with them through Let's Connect, which Sarah's already talked about, and I'll go on to talk a little bit more about. But we also support Royal Mail by going into the posting offices, depots and so on, and we sit down with their employees and we talk about the benefits platform. So we show them the benefits that Royal Mail have. It's called My Bundle. That's the name of their benefits platform. And we support the Royal Mail by going in and explaining to people what's on My Bundle. And at the same time, we talk about insurance. So that's one of the parts of our contract. And as you rightly say, that is up for renewal in September. No indication that isn't going to happen. We have regular conversations with Royal Mail, particularly at the moment. And we're expecting to go into renewal conversations. We have been starting renewal conversations, but as you can imagine, they have got quite a lot on their plates at the moment. The second part of the relationship with Royal Mail is around Let's Connect. And you mentioned, you know already that we've written down the value of Let's Connect, and that is partly because, or primarily because, of the relationship with Royal Mail changing. So Royal Mail were the major customer of Let's Connect, and they've now indicated to us that they won't be continuing with the salary sacrifice scheme for Let's Connect in the future. Now, that is as we know at the moment, and as you can imagine, there's an awful lot of changes going on, but that's what they've informed us, and we will be providing them with other services, but not the Let's Connect, not the salary sacrifice scheme. So we may well put in a net scheme, which is where people buy the items out of gross pay, so it's not quite as attractive. And we're also looking at some other options for them to bring in later in the year. But we do recognise that the Royal Mail element of the Let's Connect portfolio will be diminished. Having said that, we have 164 other clients with Let's Connect, so it's not insubstantial. And it is also a bit of a defence play for us in that we provide that service ourselves. And obviously it stops clients looking elsewhere for a salary sacrifice technology provider. So there's a mixture of both. It's valuable to us in terms of profits, even at a diminished level, but also it does keep clients working with us because we've sort of got all of the services available to them. There's another question here about assurances that the share price would improve. This time last year, it has nearly halved. We all don't know the answers, or we do know the answers to those questions. I mean, clearly, we're probably above where AIM has fallen generally. It's not something that we're dissimilar to most of AIM. The AIM index has fallen very, very badly over the year, and that's primarily as an impact of people being concerned about cost of living, the war, all of those different sorts of things. And I think obviously we have to look at the impact on the whole index in terms of the macroeconomic and global economies rather than just the impact of ourselves. We remain extremely confident in the business. We're all shareholders. We believe very strongly in the future of the business, and we can only hope that the market recognises that progression that we've made and continues to support us. Certainly our institutional investors are very loyal, and we continue to meet with them and talk to them on a regular basis about what they're doing. Oh, there was another question there about Royal Mail, which seems to have disappeared.
Thank you, Sarah. Yeah, so Thank you for that, Deborah and Sarah, and I believe you have addressed all the questions that you can from investors today. And of course, the company will review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But perhaps before redirecting investors to provide you with their feedback, which I know is particularly important to you in the company, Deborah, could I please ask you for a few closing comments?
Yes, thanks very much. So I suppose my comments would be that we feel that we're in a strong position. I mean, since I've been Chief Exec, we've gone through a period of time with COVID. We've gone through a period of time with, certainly last year, with a lot of uncertainty in the UK, cost of living increases. But I think through that period, we've proven that the business model is robust, that we have growth potential, and certainly we are starting to see extremely tangible results now on the 3 pillars of growth that we set ourselves last year. And I've been really delighted by how we're making progress and seeing the impact of the investment that we've made in sales teams, in our marketing team, and we will continue to see within the technology development that we're doing. So it feels to me that we're in a good place, and the proof points that we're seeing around the number of new clients we're winning, the contracts that we're writing, all of those things being extended is really good news. Thank you very much.
Deborah, Sarah, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Personal Group Holdings PLC, we would like to thank you for attending today's presentation. That concludes today's meeting. Good afternoon to you all.
Thank you. Bye.